Just to give a little bit of background on what PACE is, for those who are unfamiliar with the asset class. PACE stands for Property Assessed Clean Energy. It allows for financing of energy efficiency projects, renewable projects, and water conservation, requiring only a 0% down payment. The installation is repaid through an assessment that's added to the respective property. It does not follow the property owner to the extent the property owner decides to sell the property. It stays on the property through the life of the assessment. The tenor of the assessment cannot exceed the useful life of the installation. So you can't have a 20-year assessment on something that only has a 5-year useful life. And the one thing that's, I guess, semi-controversial is the fact that it primes the mortgage. So people in the mortgage industry are not necessarily fans of the asset class, which is something we're going to touch upon here today. In 2014 was the very first public PACE issuance. It was 100% residential, only located in Riverside County. $104 million, about 5,800 properties accounted for in that one transaction. As of September 1st of this year, there have been 20 public ABS transactions, representing about $3.5 billion and 125,000 properties in total. So you can see there's been tremendous growth over the last 3 years or so. With that growth, obviously comes a lot of attention. And that attention is not always flattering. So in the form of different articles that have been published to date. There have been 4 articles in Wall Street Journal, 1 in the LA Times, kind of highlighting some suspect practices, at least as what they've pointed out from anecdotal evidence with regard to PACE. On Friday, 2 bills were approved in the state of California, Assembly Bill 1284, Senate Bill 242, which addresses some of this. And I wanted to throw it to the panel to get their impressions of what's now going to be required from different consumer protections and what the actual implications are for PACE on a go-forward basis. Cisco?
Thanks. So yeah, this is kind of a historic moment for PACE. I think it's an exciting moment, and I think we've heard the growth of this industry. It has been regulated by sort of a patchwork of local governments that offer programs, states, and other quasi-governmental entities that have been paying a lot of attention, doing a lot of work on PACE. And I think the data that we've seen from PACE, from the consumer's experience, has been overwhelmingly positive, but it's not been without challenges. And as the industry has grown, and as it continues to grow, there's definitely been a need for a stable, long-term consumer regulatory regime that dealt with PACE as a unique product that was not just the same as as a mortgage or consumer loan. It's got some similarities and also many differences. So what we started working on sort of jointly in the industry, but also with members of the legislature and others in California, has been what turned into 2 bills that were designed to bring long-term stability for PACE in order to not only to work in a way that was protective of consumers and to enshrine many of the practices we've already used, improve some of them, but also to bring a lot of daylight and understanding and a regulator to the space that could kind of overarchingly look at the entire state and make sure that this was going on. So what we ended up with has been called an impossible coalition. This really came together in the end of a number of the PACE entities, the consumer group, some consumer groups, the California Bankers Association, the realtors, the land title, the local governments, cities and counties, a whole host of environmental groups and others came together to support 2 bills, AB 1284 and SB 242. I won't get into which does which. It's split into 2 bills for sort of boring reasons, but let me go through a couple of the key things that had happened, and really to importantly point out that this was a consensus set of work that happened with a huge group of stakeholders, some of which have not been fans of PACE, and I think this is a milestone for the industry. So we're seeing there now will be licensing of PACE providers and a regulatory regime overseen by the Department of Business Oversight, which is in the state of California the mortgage and consumer lending regulator. But as a unique aspect, a new chapter of law, unique to PACE. We're going to see strengthened underwriting standards across the board, as well as enshrining some, and the introduction of ability to pay requirements. So there will be now screening for the ability to pay of assessments, which has been a protection that folks, particularly concerned on the low income side, have wanted to see, that we had implemented and now state law has put into place. live phone calls to confirm for 100% of projects, 3-day right of rescission and cancellation, a whole variety of other reporting and other requirements. So together with all the disclosures and other pieces that are part of this, I think what we're really seeing is a maturing industry that's looking to go from $1 to $2 billion a year in a few states to a larger national scale with this as, I think, a very powerful model. We'll all continue to need to work on it. The regulations need to come from DBO now. There's a bunch of work that will happen in the state. Nothing is perfect, but I think the support, this, by the way, in an era of partisanship and difficult political times, this passed the state legislature, passed unanimously in the state assembly, and with only 2 no votes in the state senate, with dramatic bipartisan support. So here we have, I think, a really great policy that's been embraced, improved, strengthened, and came together with a lot of folks that have been opposing to make that happen. So I think this is a really great day. It will change some practices, but I'm excited about what's happening for PACE and the idea that this model can be used elsewhere.
Stacey, would you like something to add to that?
I would actually just reinforce maybe a couple of things that Cisco said. One is the proactive nature of this, that the issuers and all of the other stakeholders have been very, very involved in helping to advance the substantive regulations and rules to help support PACE from a consumer protection standpoint, but also from the perception of investors and other in the industry as a very responsible and thoughtful set of folks that are advancing this asset class. The second is it's a very normal maturing process for the industry, and I think we're all very supportive of that. From a standpoint of the actual content of the bills, much of what has been implemented in these bills, setting aside the DBO oversight and ability to pay, have been things that we have been working on and implementing over time since the beginning of PACE. So things like the consumer protection calls, contractor oversight, the 3-day right of rescission, prohibitions against things like stating tax deductibility or any misrepresentation of PACE. Those have all been things that have been very much on our radar, and we've been actively proponing and actually feel very strongly that it's important not only for the current leaders of PACE, but also any new entrants that enter into this marketplace, that we're all playing by the same rules, those are predictable, they're transparent, and that they're supporting the consumer in every way possible. So I think we're all very much in support of this new evolution.
So Rob and Neil, so what type of conversations were you having with your credit people when these articles from the Wall Street Journal and the Times hit? Can you kind of give us a little bit, as much as you can, give us a little bit of what's happening behind the curtain?
Well, something that's always very popular, post-crisis credit discussions is Wall Street Journal articles about nascent asset classes. One thing I would have to say is the industry has been, I think, very proactive with regard to handling of these articles, and I think that's helped the credit process, not just internally at the banks, but also with the investors. We were never surprised by the journal articles. Both our clients in the space alerted us well in advance of the articles coming out that they were possibilities of this, what the topics were, to the best of their knowledge, and prepared us and allowed us to prepare the folks internally. And then I think that they were very proactive about responding to the articles. I think some of the protections that Stacey laid out were very powerful and were very well received by our credit officers. I think the one thing in particular that I think that most troubled people internally when we were doing renewals and amendments and things of that nature were a lot of the case studies around elderly borrowers or borrowers whose English was not their primary language, and then the fact that the clients that we worked with all had utilized recorded calls and with very detailed scripts and 10-minute calls going through all the terms associated with the lending before funds were dispersed. I think that's very powerful and very helpful to our credit process.
Yeah, I would agree. The folks that we've worked with have been very proactive, which has certainly been helpful to our process. Seeing the 2 bills that were introduced this week only reinforces our view of the industry in terms of many of these consumer protections that, frankly, I think most industry participants have already been employing in their originations. I think it's normal that in a new industry, there's going to be some growing pains, and I think the industry is learning as it's going, and it's making improvements, and I expect to see, smoother sailing going forward, and hopefully, some of these isolated incidents are going to be put behind the industry. But certainly these articles haven't impeded our ability to act as either a lender or an underwriter in the space, and we think that many investors share the same view.
And just to add on to what Emil said, like we were, both Barclays and Deutsche had been in the market, in the midst of either the aftermath or just before article hit, and I think that the conscientiousness with which the issuers tackle this still allowed these deals to go very, very successfully with very large investor books and multiple times oversubscribed, and again, very successfully accessing capital markets.
Okay. Marcel, you're the only commercial PACE fishing up there, so I don't want to leave you out of the conversation. What is it about commercial PACE that allows it to, I guess, potentially have less transaction friction? Because commercial PACE generally is operating more in more states as compared to residential PACE. Can you give us a little background on that?
Yeah, I think some of the changes that are happening on the residential side are things that on the commercial side we've already been doing, such as the underwriting process and making sure that the borrower can actually repay the loans. The thing that is still different is that we require lender consent on all of our deals. And I don't think that's necessarily the case for everyone, but for us at Petros, we do require lender consent. So, I think from a consumer protection issue, we don't have any relevance to that because it's purely large, sophisticated borrowers that are taking loans from us. And as you mentioned, the footprint for commercial PACE is growing pretty rapidly right now. It's been approved. There's enabling legislation in about 33 states, plus DC. There's a program that's been launched in 19 states plus DC, and we at Petros are currently in 7, going to 10 by the end of this year. So for us, we really enjoy the fact that there is a large footprint that we can actually go after.
Okay. I did mention earlier about the growth in PACE. I just wanted to get a sense from the panel. I'll start with you, Benji, with respect to what are the questions that investors are asking now versus what they were asking back in 2014 when the asset class was first introduced?
It's been an evolution as we've looked at PACE for a couple years, and as investors get more sophisticated and see more deals in the market, they're asking for more granular data. And so we have worked with the sell side first and worked with a handful of the issuers as well as those in between to develop more granularity that can ultimately inform the investment process, both at issuance and then especially in the secondary market. And so as we work with all of those different counterparties, we're seeing things like getting granular data on breaking apart prepayment and comparing different deals, prepayment speeds by county, and there are investors, some of whom are more experienced with the asset class and will look for even more granular data and then be able to put those into cash flow models and actually try to stimulate more secondary market activity, ideally more liquidity, which should facilitate then even more questions into the space.
Okay. Any of the bankers want to talk about this? But you guys are on the road shows.
From my perspective, we had an incredible amount of interest from new investors in the most recent Renovate America transaction, and frankly, we had to field a lot of questions just in terms of educating folks on the product itself, just because it is very unique in terms of being both a public-private partnership and also the very unique nature of the collections being by the local taxing authorities. So I think there's a lot of credit positives obviously with the product, both in terms of the priority lien position as well as the collection mechanisms that we found a lot of investors got a lot of comfort from.
I'd just add on to that. I'd say that, I'd echo the comment around more granular data. There's certain investors, larger, sophisticated investors, who have asked, about, particularly prepayments and more granular data. That does come up occasionally. I would say that the primary, questions, because of how the Wall Street Journal articles have been spaced out, have been actually a pretty consistent drumbeat of investor questions. Just because, again, the way they've been spaced out seems to be like every few months. So that's been, I think, the majority of the questions that we've seen. from the investor side. But I do think that really hasn't dissuaded, every deal that, I've worked on in the past 6 months, you've actually seen, 2 or 3 new investors in every book. So I still think that there's a lot of appetite out there, even if there may be 1 or 2 investors who are dissuaded by the quote-unquote noise around the space associated with Wall Street Journal articles. The books are still very, very diverse and well bid, and my sense is that there are probably more investors who are looking to get involved.
So you have a different business model than White Green or Renew. Can you give an explanation? I guess a little background in terms of how investors see your product versus potentially residential PACE?
Sure. So, we do work a little bit differently. We don't necessarily have to put loans on a warehouse line to pull them up to securitize and sell in the secondary. We actually go direct to the investor groups. So we've got purchase agreements with several investors, institutional investors, where they effectively securitize each loan that we do on a deal-by-deal basis. So it's very different than most others in the industry.
Okay. Recently, we've seen the suspension or cancellation of PACE in Bakersfield and the unincorporated portions of Kern County. Can both Stacy and Cisco kind of give us a little bit of background on what other headwinds are there for residential PACE as it tries to enter additional states?
You give us the fun questions.
Sorry.
So I would say that the good news about PACE is that it's always been very much a bipartisan topic. And I think that's evidenced by the fact that, for instance, we started in California, but the second state we opened was Florida, and then Missouri, now Georgia, all very red states. So what we see is that the Democrats in the room really like the idea of environmental protection, climate control, energy policy. The Republicans gravitate more towards job creation, economic stimulus, using private capital in a public-private partnership to do good, et cetera. I think in this instance with Bakersfield, what we saw was a kind of unique confluence of things where it was a very red district where the environmental policy isn't as valued, kind of in general, with a very local effort by PACE detractors, i.e. the mortgage bankers / realtors who don't like the priming nature of PACE, and that confluence of events actually saw that jurisdiction rescind their PACE efforts. Now, I do believe that that's a relatively isolated incident. And it's immaterial to the overall origination volume of PACE, but it's something that's certainly a general risk in the market. Every jurisdiction chooses whether they want to have a PACE program in place or not. They can at any time decide they want to continue that or not continue it. But because of that diversified nature of the opt-in by hundreds or thousands of cities and counties, it doesn't necessarily affect PACE overall. Certainly something that we're not seeing in terms of headwinds. That conversation, I don't believe in any other jurisdictions, but that was the situation there. Cisco, I don't know if you have kind of
Yeah, I can understand why this became a hot topic, except that it's totally made a mountain out of a molehill. In the period of time since, I believe it's over the last couple of 3 months, 47 jurisdictions have opted into PACE programs. And so we had 2 opt out. Others have opted out. This is the nice thing about local government. This is that they have control. They can choose whether they want to offer it or not. I think that's fair and reasonable. But I think the overwhelming sentiment is on the other side. That said, let me just for a second say, when I first started this out, when we first were trying to figure this thing out 10 years ago, we're trying to solve a problem, which is people were wasting energy. We had a climate change issue to address. We have all of these important ways that folks who are more limited incomes could potentially save money and save energy, but didn't have the upfront capital to do so. And so for a variety of reasons, people bought into that as it's an enabling a community to make choices, individuals to make choices. And that's been a very powerful bipartisan issue. But, I spent yesterday morning touring projects in Miami that we had financed for wind resistance. So, now we're talking about people trying to save people's lives. That this is about the city of Miami, Miami-Dade County, providing PACE as an option, not just to reduce their energy bills, which they can do, but in large part also to create changes to their homes that make them safe in a hurricane, which we just had. So this really is about empowering local communities to take control of their destiny, to not just save money and energy, but now to move into these sort of serious life safety issues. I'm very happy to find that all of those homes were still standing and all of those projects seemed good. But the bigger point of it was, I think, falling back and remembering when we talk about all the cities that have joined in, we talk about all of the billions that we've done, that every one of these is a community trying to deliver a service to their, city trying to deliver its service to its community, and that homeowners making choices to improve their home and to improve their life and to protect their family. And in the end, that's what's driving demand. That fundamental piece is why local governments are enabling and individuals are using it. So that's why I'm excited about the laws that we've passed in California to put clear rules in place for all time. But I think it's also important to step back and recognize that while a couple have opted out, lots have opted in, and the fundamental nature of the improvements we're making, the benefit that we're having to society is unique. I also think that's one of the reasons that there's so much interest in discussion about this, is it's not just another financing product.
So why only California and Florida now? You said Missouri and Georgia, but they're not as active as California and Florida. Why are those two states these states only at this point?
Well, states are the laboratories, and I think you have seen 33 states pass this legislation, 19 with active programs. You've got several with residential programs either up and running or coming over the next period of time. Look, I think that the concerns raised by FHFA and Fannie Mae and Freddie Mac and other things, and some of the reporting you've talked about, has led to people being a little reluctant, wanting to make sure we get everything locked in. Mm-hmm. So from my perspective, I think we needed three things, and I think we're closing in on two of them, and the third we still have to do. Very quickly, the first one is the data. This has come up a lot. The terminology in tax collections and just what a delinquency and other things. I mean, this is one of the article in the Wall Street Journal just got the data wrong because they're misunderstanding what the terminology meant when you're changing between these municipal finance and other things. And that's an easy mistake to make, in fairness, but it shouldn't have been made, and we need to get better about transparent data. It's one of the reasons it's in the bill. It's one of the reasons we're all working together to try and make sure that data comes together. We can put it out, everybody can understand it and make the choices. Mm-hmm. The second is consumer protections, having those laws in place. We've talked about them. And the last piece is going to be addressing the lien priority concerns from Fannie and Freddie. And I think there's a number of strategies to do so, a lot of good discussion and work happening. And ultimately, over the next year, that's my goal. So I think with those three things in place, we are going to see the rest of these states start to open up their residential more quickly. It'll take a couple of years, but we're moving in that direction.
I would just add that layered on top of that is the natural evolution of business growth from the standpoint of each one of these PACE companies started from zero not too long ago. So the notion of opening up a full state and then moving to the second state and the third and the fourth, something that actually requires operating capital and scale resource to do. So layered on top of the market development activity is also the natural growth curve of those organizations that are now serving those markets. And opening up a state does take substantial wherewithal, which only a few players in the market have at this point.
Then we'll shift the conversation to structures. The predominant structure was the single tranche, 97% advance rate, but now we're seeing premium bonds, we're seeing residual interest repacks, and now we're seeing the immediate monetization of excess spread. Can Rob, Emil, you're the financial engineers here, can you guys kind of let us and give us a cue as to what's happening, coming down the pike here with respect to structure?
Yes, I think it's a really good overview of what's happened, and the fact that one thing that we had seen late last year, and actually at this conference, hearing it really the first time, was like, yeah, seniors great, really like the credit story, but we want more. We want the credit married with yield, and how can we do that? So you start seeing more in the way of residual repacks, more subs. Wygreen issued a small sub out of their a primary ABS trust, which actually got a very good reception, even though it was a very small sub, and you've had structures evolve from there. So I just think that you have a very, very substantial appetite, a lot of inbound calls that we get on how can you play in the residual, how can you play farther down the capital structure in PACE to get a little bit more yield, because people just have bought into the credit story. Mm-hmm. So I think that's obviously going to continue. I think in terms of structural innovation, I think that with the Cayman SPV structure that Renovate pioneered last year, I think you'll probably see some additional time tranching in deals potentially. You may see some credit tranching in deals to actually include your AAAs. I know that, Cecil, you may have some views on that too. But I think that there's still some evolution to be done with regard to the structure.
Yeah, I mean, look, I would echo that. I mean, if you have a structure that works, and it's not broken, it doesn't need to be fixed, as the old saying goes. And there's certainly been a lot of demand recently for the current structure. But I do think as the asset classes evolves, as new rating agencies come into the mix, and as that asset class migrates to AAA, I think that there will be more value add to things like time tranching and other structural features. But I think for the time being, in terms of, let's say, the next 3 to 6 months, I think changes will probably be incremental.
So I'll address what Rob alluded to. So all the deals that Kroll has rated, the senior tranche has been AA, and I've been asked to opine on why nothing we have rated has been AAA. And for us, there is a regulatory overhang that we've been alluded to here with respect to FHFA. These are long tenor bonds, 30 to 40 years in some instances. And there is a pro rata delevering. So the advance rate, the 97% advance rate, is out there for the life of the bond. If you want to, how we look at these internally is that we compare these to tax liens. We look at the tax collection payment history in the respective jurisdictions, and that serves as a proxy for the performance of this asset class. So if you want to extend that comparison to tax lien ABS, in tax lien ABS, those deals are all full turbo, for one. And so there's a huge structural element, so you're not actually out there for 30 or 40 years potentially. And the excess spread is much different. The statutory rate on a tax lien deal, generally speaking, is above 10% versus these deals, you're looking at 7 to 8% on a weighted average basis. It generates about 4%, 5% of excess spread. So from the qualitative standpoint is regulatory overhang, and the quantitative standpoint is just how the deals are structured currently in terms of the pro rata share of the potential extension risk that goes out to the maturity of the bond. That work for you?
I will note we are seeing other rating agencies that have.
Yes, they are.
And I also think that if we start looking at things like time tranching and credit tranchings, where we can start to change the tenor of the seniors to get shorter duration and bring in other types of investors into the asset class, it also, I think, we'll see ratings on those senior pieces move more and more to AAA. So I think some of the structural changes that Rob alluded to, you might see more of that coming down the pipe.
Yeah, as I said, I was just thinking about, I'm not sure if this is the right form, but one thing that could potentially happen is that you may just not have a 97% advance rate for the AAA tranche. You may have a 95% advance rate for the AAA tranche, or something along those lines. In any event.
The last thing I wanted to cover is just to talk about the PACE Act 2017. It was an act sponsored by the two senators, Cotton and Boozman from Arkansas, and Senator Rubio. I'm not sure exactly if what's happened on Friday makes that a moot point, but I don't know if you wanted to comment on their push to regulate PACE as mortgage originators.
Look, I'll say what the basic answer is, my company is in favor of strong, workable regulatory regime for PACE. States have a long history. This is a state-level product. Each state has a different set of laws that govern how PACE works. We think the regulatory regime, states are used to regulating lending products of all different types. They have whole regimes for that, as we see in California. So we think the model in California is great because it is at the state level and because it created a new chapter to deal with PACE as a unique product. The flaw with the Cotton bill was that it didn't do that. It just said, hey, this is a mortgage. And it's not a mortgage. I mean, for one thing, you can't service it monthly. You have to service it twice a year. There's no way around that. And so it was a sort of a political act rather than a real act of policy making. And I don't think it's going to go anywhere, in part because it doesn't solve the actual problem. It's just harmful. So what I hope happens is that states will follow the lead of California and continue to move forward in good ways that make sense for them. And if there's an appropriate move then forward with in the Senate or the House for a bill, that it'll take the basic approach that California took and say, hey, this is different, let's put this in its own box and figure out how to deal with it. And then when you start from that approach, I think it's pretty reasonable to come to a good outcome. So we've certainly had conversations with many members of the Senate and of the House. I think there's general support for PACE and for that approach.
Mm-hmm.
Not much is getting done in Washington. I don't see that changing anytime soon. But I think over time it may be appropriate that there be some federal aspect to it. And I think that embracing it from the perspective of how California approached it is absolutely the right way to go. The Cotton Bill was a very flawed piece of legislation that would not have actually accomplished the goal that they stated they were trying to accomplish.
Anything to add, Stacey?
Totally agree. I think really that in some sense it was more of a political bone to throw to large donors who are supportive of those particular politicians, and not necessarily a law that had language that would, as Cisco said, achieve the goals that were really put forward as being those that they were seeking. I don't see it moving, so I think that's good news. I also think that the recent passage of the bills in California provide a model that have substantive content that actually works for PACE and can be replicated in other states if we get the politics right. So would agree that I don't think there's any real concern of that bill moving in this session or potentially in future sessions, but we need to keep our eye on it, and we need to make sure that the best of what we're learning and putting in place in California as an example, that we continue to propone proactively as an industry in other states, and that the solutions happen at the state level.
I'd like to open it up to questions at this point. We have plenty of about 15 minutes left, but if anybody has any questions? Adam.
The Wall Street Journal was mentioned several times.
Can you hear me? Is this mic on?
I'll just shout. It seems as if the articles were fairly unbalanced. Any idea why the journalist does not write about the positive aspects of PACE and balance out the work?
I can take that one.
Okay.
So the question of why is one that's going to be really hard to answer, but I can give you some color on that. So I think it's important to note that the articles were largely written by one journalist. This is not sort of a widespread attack with a sort of united front of folks who are thinking these things about PACE. And it's spurred from our understanding by a core detractor of PACE, the mortgage lenders, who, of course, do not like the fact that a tax lien primes the mortgage. Why there's a openness for this journalist to receive those messages, I don't know, but I think that it's important for investors to know that they were motivated by a desire to damage PACE, not necessarily tell the truth. So a lot of the articles have contained misinformation. I would say also with 180,000 properties benefited by PACE, it's clear that a couple of anecdotes don't make a trend line. Right, so they're sort of a tempest in a teapot kind of thing. But that being said, we're really, really, really concerned and care about every single consumer and making sure that we're doing things the right way. So there's the unfortunate part about the articles is that they actually raise claims that in fact the industry has been very, very focused on addressing for years. Even ironically, one is around the way contractors are involved in PACE. And if any consumer goes to do home improvement or an energy upgrade using a HELOC, for example, right, the mortgage bank doesn't even ask who their contractor is. The mortgage bank doesn't care. They don't track the contractor. They don't ask whether the work was done well. They just say, you're approved. Similarly, if the consumer uses their credit card with a very high rate, there's no one overseeing the contractor and ensuring that the job is done right. Ironically, PACE is the only industry that I know of in the financial services space that has actually spent considerable time and expense to develop a whole regime for how to train, certify, oversee, and ride herd on contractors so that consumers have a good experience. And in a general industry where contractor happiness ratings may be, less than 20% or some very high number, our complaint rates are in the low single digits. I mean, for some time we've been running like half a percent to 1%. So to have the journal sort of slam the industry for the involvement of contractors in the process when we're the only ones that anyone could point to that have actually implemented those kinds of regimes is, I think, disingenuous. The other areas like consumer disclosures, we offer all of the know before you owe TILA disclosures, have been doing that for quite some time, feel very, very strongly about it. The articles around delinquency rates where she wrongly used the term default rate to describe delinquencies. We all know they're very different things. And when shared that our delinquency rates are running inside prime mortgage, our default rates are near zero, and there has never been a single foreclosure in the industry. Those are things that just were conveniently not reported. And so I do think it's important for investors to know that there are answers to many, if not all, of the questions that were posed in the articles, and that I think all of us have been pretty darn proactive about reaching out each time an article comes and having one-on-one conversations about what was said, what was correct, what was incorrect, what are we doing to continue to increase the level of consumer protection, and really to make sure that everyone understands what is true and real about the industry.
The only thing I'll add to that is, it's hard to know the motivations of a single reporter and speculate. I mean, we all have our theories, as Stacey just, gave some of her views. But I think that the industry is very well served by really great ambassadors like Stacey, for instance, who, on her last transaction spent a tremendous amount of time in investor offices, being, pelted with tons and tons of questions around these articles. The end result being, after a week on the road and a lot of these meetings, having a fantastic transaction. So I think having leadership by folks like Stacey and other people in the industry doing things like that, being very proactive and telling the story in a very respectful way, counteracting some of these things, does a lot of good.
I think it's important also just to add, not to lose sight of all the positive benefits that are being created by virtue of this industry. For example, the creation of over 30,000 jobs. Last time I counted, over 1.5 billion kilowatt hours of electricity that's been saved, over 10 billion gallons of water that's been conserved, and over 4 million tons of carbon dioxide that's been reduced as a result of PACE. So, it was certainly a focus for our organization when we got into the sector to focus on, the positive environmental impacts as well as the positive impact to the economy.
That's a good point to dovetail, if you can hear me. But it'd be interesting to know what new pent-up demand there may be for hurricane hardening here in Florida. Do you happen to know were there any CPACE projects that had less damage than others because of the development of the project?
I know in California we've done seismic. We haven't done a lot of CPACE projects with hurricane resistance yet in Florida. We are looking at a couple right now, but I'm assuming that after what just happened, I think there's going to be more demand for it than there was before.
Sure. So that sounds like it's also time to find some good reporters as well.
Right.
Report the other side of the story.
Yeah. Yeah. Seems to be very one-sided at this point.
Following up to that, is solar plus storage an eligible measure in all the states that you operate in or know of? I guess for resi and for commercial. And are you seeing any trends there or having predictions or projections related to that asset class?
I believe the answer is yes, from a standpoint of eligible measures. I know it is in California, and I believe it is in Florida and Missouri as well. We haven't been seeing a very large demand. I think the solar providers sort of would represent the same, certainly for solar, but solar plus storage is still emerging. I think we had expected to see it grow faster than we're seeing, but still think there's an enormous opportunity there, and it's something that our solar team is pushing strongly.
Solar and storage for commercial users can be extremely cost-effective, particularly in states like California, and I think on the residential side, that cost-effectiveness is not yet there. I think it's coming slowly, or quickly, actually, in the greater scheme of things. There's been a lot of discussion in Florida post the hurricane about folks who kept their lights on because of that. And so the added cost may become something that people are interested in bearing in order to have the resiliency that comes from that. Frankly, we're so close to after the hurricane. I mean, I was just out there that, you know, it looks nice here. Like much of the city does not look like Miami Beach, this road does. There's huge piles of debris, a lot of damage. We were mostly concerned with our employees and our contractors being safe and protected, and now finally hoping getting back to work. So we'll see whether that emerges now in the post-hurricane space, but it's too early for us to have seen any of that.
And I think on the commercial side, solar just in general hasn't been a very big measurement that we've financed so far. We've financed primarily chillers, boilers, HVACs, lighting controls, cool roofs, window tinting, those kinds of things, which are more of the items that borrowers or property owners have to do. And right now, solar isn't a have to do, it's kind of a nice to have at some point. So at this point, we just haven't seen a lot of demand for the solar side.
Anyone else? Okay. I'd like to thank the panel for sharing all their knowledge about the space, and it makes a good conversation. Thank you.
Thanks, Cecil.
Thank you.